What do I mean by that? Well, we're beginning to see neutrality and some consolidation here. The first coming stages of it were on somewhat lower volume. We saw a huge volume spike. We hadn't seen a volume spike into this high 300,000 daily shares traded level in months, in years really. Last time we saw these levels were back in March. So I guess it would be months. It would be months. Actually, no, it would be a year. It would be over a year now. So we haven't seen volume patterns like this in over a year. But the main thing that we're looking at is for this 1575 level to hold. We do have the 50-day simple moving average. We also have a lot of downside pressure and some resistance here at 17. But 1575, 17, kind of stuck in that range. We have that higher area of the 38.2 Fibonacci retracement resistance there, and that's coming off of that lateral trend line here. But if you look at the shorter term simple moving averages, and if we isolate those, we can look and see that normally when you get that 5-day crossing below the 10-day and presumably crossing below that 20-day simple moving average, you're seeing momentum being taken out of the market. Now, I've used this strategy since I really started trading, and it's really come in handy to see different kinds of momentum shifts when you see these different kinds of crosses. How far it'll go, that's all dependent on what happens in the future. However, right now, I'm not getting in the market when it comes to the financial sector anymore. I played my regionals, I got in, I got out, I made my money, I'm done with that. I did miss a couple moves, but hey, I made a lot of money off the regionals in the past 2 weeks. So we're not going to push any more out of the financial sector. It's not necessary. We're going to wait for it to recover. A break over 17 in the XLF is definitely something to keep your eye on. Moving to XLV here, XLV is a very different story in comparison to the other ETFs. Completely broke down mid-April. Died. When we broke that 100-day and that 50-day, and again, we saw that weakening in momentum. We had the Fibonacci level here at 61.8, which was very similar to this here, and we're seeing a very similar pattern. We saw this, this push here, low volume, not really low volume, but declining volume this whole run, a very weak run, trying to push that $33 level again. Couldn't do it, and we just puked. Momentum was lost. The sellers came in, distribution came in, price just fell and collapsed, and now we're sitting at $30. $30 is a spot to watch. We have the 200-day simple moving average coming in. The 50% Fibonacci retracement level is one to really keep your eye on because it's also a very large and very important lateral trend. This is very similar to what we saw back last February and last June when it comes to the XLV, in 2008, not even last, right before the market puked. So, we're getting to these levels where it's getting very touchy. I've stayed very thin lately because of it, and running through these ETFs and reminding me, hey, you're looking at these, you're seeing some really, really sketchy patterns here when it comes to technical analysis. You might want to lay off. Because I'm not at my monitors 24/7, if you're like me and you're a part-time trader and you're not at your monitors 24/7, stay light and be very, very careful where you allocate your money. Be very, very careful with that. 200-day simple moving average is one to watch. 50% Fibonacci retracement. Below these two, XLV can drop $2 all the way back to that $28 level. Moving to XLI. And this is one that I really, really want to cover because I've been immersed in the industrial goods sector because of my MTW call. That report will be out for the subbies later this evening. But for the most part, the company tanked 14% off of the low analyst estimates. And this is a leading company in the industrial goods sector. So what does that say about the industrial sector? Where is the weakness? I got a tweet. I received a tweet from Legacy Trades, and I was discussing the different kinds of things that happened and the analysis that went along with my MTW call. And he said, what do you think it was? Do you think it was weak management, or do you think it was a soft economy? My take, it was a soft economy. It's a shame to say that because we've had the construction numbers and the manufacturing index increase for the last 3 months after that big drop from I think it was December to January. It was either December to January to February. I cannot remember for the life of me. But in there, we've had a steady increase, if not a rapid increase, from that somewhat heavy decline in that index. So we've seen some setback there. But again, in the first quarter, overall, that manufacturing index was very solid and produced some fantastic numbers when it came to manufacturing growth, manufacturing production, and manufacturing as a whole. So when we look at the industrial select sector, we're targeting these companies that deal primarily with the industrial goods sector and the manufacturing index. We haven't seen volume accumulation this high on a daily chart ever. We have not seen volume distribution the day after that high ever. We are breaking records with volume. What does this mean? If we look, and I have it mapped out here, if we begin to look, volume, a lot of volume are inflection points. And I'm just going to highlight these very quickly. We have this here. Well, what's that marking off? We have a large volume influx. We had a huge decline. And then we push back up on a weak volume. Puke. Here we go. Just going to activate that and switch it over. Inflection point. Huge puke. Volume. Not much there, so it was just sort of, and now we had this huge volume here off of that, of course, the economic collapse. Volume, stayed primarily steady through a lot of different price swings, huge price swings, small price swings. We had the, inverse head and shoulders. We continued higher, and now we're seeing that inflection point, that theory, I guess you could call it, but you're seeing that inflection point strategy that you have here, where you have a correction, you have huge volume, and I pointed this out the last time, actually, that I went over the Spider ETFs. We had this correction, broke the 50, broke the 100, now we're sitting on this trend line, and then it popped, a huge volume out of that. And then, week, all the way here. And now we were hit with this Goldman Sachs thing. Well, what happens? We get huge volume, but we're staying above some critical price levels here. What do I mean by that? Well, we have this lateral trend line here at the 61.8 Fibonacci retracement level at $32, and we're staying above it. We have this descending trend line here that's coming in pretty tight, and we're seeing volume records in XLI. What does this tell you? This either tells you, A, we're going to roll over in XLI, but it's going to be one of the last ETFs and the last sectors to roll over if the whole market goes, or B, if the market goes higher, this is going to be one that could break out and really push. If we break out above this descending trend line, which has held the price back on this coming run that we have here, we have a lot of support. We have a great base of support here. 30 being really the lowest it could go if we break the 50, because we have the 100-day simple moving average here. But if we do roll over, we have a good padding system with the simple moving averages. If we break out, we have 36, so we already have a 2-point move. Risk reward, not bad. 2-point move either way. And if we break above that 78.6 and that $36 level of this lateral trend line here, boom. Then you have a 6-point move to 42 and new highs. 4 to 6 points, give or take. So XLI, if we do in fact break out, is going to be one sector. Industrial goods is going to be one sector to really watch and hone in on.